So things are likely going to get worse for Canada's economy before they get better. That's what I'm going to be talking about today. My name is John Pasalis. My team and I help buyers and sellers throughout the Toronto area make smarter real estate decisions. If you'd like to meet with me and my team to discuss your own real estate decisions, you can just click the link in the show notes below. So this recent rate cut by the Bank of Canada has fueled a lot of optimism in the real estate industry. Realtors and owners of brokerages and presidents of companies talking about how this is going to stimulate demand. Buyers are just going to rush back into the market. Prices are going to skyrocket. Now's the time to buy. Get ahead of the rate cuts. This is the time to get into the market. And last week's video, I talked about why I'm not buying those arguments. I kind of unpacked a number of reasons. One thing I didn't unpack, which is I think an important thing to think about, is where things are economically right now, and are these the conditions for this really bullish housing market? And I don't think they are. I mean, we saw a headline last week about the number of households in Ontario that are very delinquent, severely delinquent on their mortgages, which means 90 days past due. And that exceeded $1 billion for the first time. That is double the pre-pandemic levels. So we're seeing a big increase in the number of households that are delinquent. We're seeing, of course, increase in delinquencies from all types of credit debt, whether it is loans, car loans, or credit cards. And again, we're seeing the weight on both households and on businesses. So I think this is a good opportunity to bring up a chart that Ben Rabidoux, housing analyst, who was on our show, actually, I interviewed a few weeks ago to talk about macro trends. He shared this chart on Twitter, and he basically said this is a good time to remind everyone that historically the pain for borrowers starts after the first rate cut. And what he's showing on this chart is the total delinquent mortgages in blue, which accelerates after the first rate cut, which is the dotted lines in red. So, and again, the severity, the significance of the increase obviously varies depending on the period and a lot of other factors. But the point is that delinquencies typically increase after the first rate cut. So why does that happen? Well, because it takes anywhere from 18 to 24 months for the effect of the Bank of Canada's higher rates to actually work their way through their economy. Just because they hiked rates a couple of times, it doesn't mean everyone goes delinquent on their mortgage. People hang on as long as they can until eventually they can't. And again, obviously it's taking some time because a lot of their debt is mortgage debt. If they were on fixed payments, they weren't feeling the effect of that until they had to renew. So the number of households who are renewing now at much higher rates are probably feeling the pressure of these increased interest rates a lot more on their household finances. Obviously, anyone with a line of credit or home equity line of credit has been feeling the weight of those increases since they started. So again, it's taking some time for these higher rates to work through their economy. Now, the actual number of households, like as a percentage that are delinquent or on their mortgages, is actually still quite low. But I think and I think that's what some people mention, but I think that kind of misses the point. The point is that they are increasing. And even if the absolute number of households that are delinquent on their mortgage is low, it doesn't mean that there isn't a lot of strain on the economy. Mortgages are the last thing people will default on. People will default on their credit card debt. They'll default on their car loan. They'll default on everything else before they default on their mortgage debt. So, this is the sort of the last chip to fall, obviously. But we're seeing, obviously, the weight on all types of credit debt. So, it's an important trend to keep an eye on, both because it has direct and indirect effects on the housing market. I mean, the direct effect, of course, is as we start to see potentially more people deleverage by selling properties. And we're seeing the direct effect of that in the condo market right now. Disproportionate number of people who are listing their condominiums for sale are investors. A big part of that is them trying to deleverage to take some of that debt off of their books and those payments. The interesting thing about the condo market, is many of those investors have capital in their properties. Like they have, 6 figures of equity in them. The challenge they're having is in servicing their debt, especially if they've had to renew their mortgage recently at today's higher rates. So it's a unique market where, it's not like these investors are underwater where the properties are worth less than what they paid for them and they have no equity. They have equity, they just can't service their debt. So we haven't seen a ton of downward pressure yet on condo prices. Many are hanging on, and I suspect for this reason because they have equity. But we're seeing listings hit an all-time high for condominiums. So we'll see obviously how that plays out. The other indirect effect, of course, is how higher debt servicing costs weigh on household spending and household consumption in the months ahead. Of course, if delinquencies are increasing, it means, a lot of other households, even if they're not delinquent on their mortgages, are feeling the pressure financially. They start spending less at restaurants, they start spending less on consumer goods and in other places. So this, of course, impacts other businesses and impacts obviously the economy a little bit more broadly. So there are direct and indirect effects that we'll need to keep an eye on. How does this all play out in the housing market? What do buyers and sellers need to be thinking about? And again, I think it's really hard to predict because, if we look back at the chart that Ben showed, the change or the increase in delinquencies depends and it varies. I mean, from significance to relatively modest. I don't think anyone's expecting, these mass delinquencies like we saw during the US financial crisis. But I think it's still an important trend to keep an eye on. I think it's probably going to impact the different segments of the market differently. Condos are probably might feel a little bit more pressure. Again, because this is where we have more investors who tends to be more leveraged, who wants to unload their properties to deleverage to take some of those debt servicing costs off of their books. We're seeing less of that dynamic in the low-rise housing market. So, I think the takeaway right now is that I would not take, the bullish chance about rushing in, now before the rally starts in the housing markets too seriously from the real estate industry. I don't think we're going to have a very robust bullish market over the next, 6 to 9 months or so. I think where the market's going to be in the new year will be interesting. We'll see how things evolve for the rest of this year, but I have a feeling this year is going to be probably still relatively sluggish. We're not going to see some rapid boom in prices and demand. And again, I think it's because we're not expecting too many rate cuts this year. But again, we're also still going to be feeling the effects of these higher interest rates. So I think we need to monitor closely where things are going to be going over the next 6 months, because obviously that's going to have a big impact on where things go leading into the new year. If you have any questions or comments, please post them in the comments below or shoot me an email at askjohn@movesmartly.com.